So there is a very common misconception about how option assignment actually works. So for example, let's say I sell an option as an opening trade. It could be a covered call or a cash secure put, doesn't really matter. But the misconception though is that if the buyer of that contract decides to exercise it, then I, as the seller, will get assigned on the contract and therefore must fulfill the obligations on that assignment. Well, as you're going to see in this video, that is actually not true. And also, just because you have a short contract that expires in the money, that also does not necessarily mean you're going to get assigned on the contract either. And so in particular for this video, we're going to explore how option assignment actually works through some basic examples. And as you're going to see, this is actually an entirely random process. Now, as always though, before we dive in here, make sure you guys watch until the end of the video because at that point, I've got a very cool limited time opportunity for you all where you can receive up to 10 free stocks and each stock could be worth up to $2,500. And also for anybody who would like to join a very exclusive online community where you guys can really learn how to successfully trade options, then you can now join my options trading Discord. So make sure you guys check out the description of this video below because I do have a link to a separate video that will tell you guys all about that Discord and discuss the main features and benefits, and also a link to my sign up page where you can join and begin your 7-day free trial. And finally here, for anybody who is brand new to the channel, my name is Scott, and you can also find me on SKILLSHARE as well, where you can take my very detailed classes on options trading or stock market investing. And you'll also find some links to a few of my introductory courses in the description of this video as well. So be sure to check them out, and when you join SKILLSHARE using any of those links, you'll get a full 1-month free trial. Alright guys, so before I can explain exactly how option assignment works, I first have to explain what the Options Clearing Corporation is, or basically the OCC. So the OCC is the clearinghouse for the entire derivatives industry in the US. So of course that includes things like options, futures, and other forms of derivatives as well. And just to clarify a bit more here, clearing is the process by which financial trades are actually settled. So ultimately, bottom line, the OCC just ensures that all obligations for a certain trade are met and that the transfer of funds and securities between the buyer and seller of that derivative is completed properly. And so naturally, of course, this also means that the OCC is in charge of managing and delegating out the option exercise requests. Right, so basically option assignment begins with the OCC. And so now at this point, having explained all of that, we're now going to move on to a basic example that's going to clearly illustrate how option assignment really works. And so as you can see here, we're going to do so with a simple diagram where at the top you can see the OCC, that's where assignment begins, and then below that we have 3 different brokerage firms, brokerages A, B, and C. So for example, brokerage A could be TD Ameritrade, brokerage B could be Charles Schwab, and brokerage C could be Robinhood. And then below that, you can see that each brokerage has 3 individual clients or customers where each customer has an account with that brokerage for options trading purposes. And so now the way option assignment works is, let's say somebody out there decides to exercise their contract, and so once they do so, the OCC receives an exercise notice. Right, basically just a notification about that person's intent to exercise their contract. And then after that, the next step is the OCC will randomly select a brokerage to assign the exercise notice to. So again, in our example, we have 3 different brokerages to choose from. So let's say the OCC randomly selects brokerage C for this exercise notice. And then finally here, the last step is now the brokerage firm will randomly select one of its own clients or customers that has a short option position on the exact same contract, same strike and expiration, etc., and they will get assigned on the contract. And so as you can see here, brokerage C randomly selected customer 7 to get that assignment. Now with that being said, I will say that the brokerage firm does have the power to create its own process for assigning customers on contracts. So the process does not have to be random, but it usually is. But there you go. That's literally how option assignment works. It's a totally random process, which means there are 2 main takeaways or implications from that fact. So number 1 here, this means that the person or the institution who technically bought your contract, right? I mean, someone has to buy your contract in the first place. But this means you as the seller of the contract are not going to be the person who gets assigned on it if they choose to exercise the option, right? Chances are that somebody completely different is going to actually receive that exercise notice and not you. And number two here, if you do have a short option position that does expire in the money, this does not mean you will get assigned on that contract either. Now, of course, there is still a very, very high chance, almost a certainty, that you will get assigned on that contract because most options that do expire in the money will be automatically exercised by brokerage firms. But if you are simply not selected during the random assignment process, then you will not get assigned. And so with that being said, that's going to do it here for this video. I hope you enjoyed it. But of course, one last thing, as I mentioned, I've got a very cool limited time opportunity for you all where you can receive up to 10 free stocks. So basically, there is a newer brokerage company out there called Moomoo, which is based in Palo Alto, California. And again, for a limited time, they're offering you the opportunity to receive up to 10 free stocks when you open a brokerage account with them using my link in the description of this video. And so the Moomoo trading platform is highly competitive with other comparable platforms like Webull and Robinhood. There are absolutely no trading fees on stock or option trades. You also get direct trading access to US, Hong Kong, and Chinese markets, which is something I have not seen being offered by competing platforms. Moomoo also comes with a free, very advanced, yet totally user-friendly trading platform that you can install on your computer or your smartphone. And of course, everything is regulated by the SEC and FINRA, so your trades and your investments are properly insured. And so if that sounds good to you, then again, use my link in the description of this video to sign up and get your free stocks. And also don't forget to check out and join my options trading Discord as well as my Skillshare courses. Links also in the description of this video. And finally here, if you enjoyed this video, then please give it a thumbs up, drop a comment, and subscribe to my YouTube channel. I drop new videos every single week and you don't want to miss out. So thanks again for watching, and I'll see you next time.